Hello and welcome to Options in Plain English Advanced Edition. Today we're going to be talking about one of the most important synthetically equivalent positions in options trading, a covered call being the same as a short put. This comes as a surprise to beginning traders because the mainstream belief is that covered calls are very safe trades, but short puts, especially naked, are considered very risky and dangerous. Well, prepare to get your mind blown because we'll see how a covered call is synthetically the same as a short put. To begin with, we're going to take a look at a covered call. A covered call is made up of long stock plus a short call. The short call is usually out of the money, so it's at a higher price than where the stock is. And if you look at the a P&L line for it, the solid line here, the max profit is at the strike price where the call is, where the short call is, and any price above that, there is no more profit to be had for this position. On the downside, it's completely exposed, so it can go down to zero, and you would lose your whole investment minus the credit for the initial call that you sold. If you compare it to a short put, the short put is made up of only one leg, which is the put being sold, and it has the same P&L line than a cover call. So you have here is a max profit right at the short strike where the put is, and at any price above it, you're not going to make any more profit, but you're going to keep that profit. And on the downside is going to be completely exposed to the downside minus the credit you received for the put that you sold. So as you can see, they are very similar. In fact, they're synthetically equivalent positions if you use the same strikes. Now, notice how the short call on the left, so on the cover call, is out of the money, while the short put on the right is in the money. So if you can take a look here, this is the at the money. You're selling a call that's out of the money. And in the case of the short put, your price is here, and you're selling a put that's in the money. Using a simplified version of put call parity, excluding dividend and interest rates and cost to carry, we're going to have a formula for long stock being long call and short put. If we solve for the short put, you would have long stock and short call being equal to short put, which is what we have right here. Okay, so if we take a look at an example here, we're going to have for a stock trading at $100, the 105 call trading at $3. This is an out of the money call. And the 105 put trading at $8. This is going to be an in the money option, an in the money put, where the intrinsic value is already at $5 and the extrinsic value is $3. So a total of $8. So if we go with a cover call, you would have the long 100 shares at $100 and short one contract of the 105 call at $3. In the case of the put, you would achieve the same thing by being short one contract of the 105 put at $8. Keep in mind, this is an in the money contract, an in the money put. So let's analyze the cover call side. You have a max profit of $800. Why? Because you have 100 shares at $100, and then you are getting a premium of $3. So $300 you get as premium, and the stock can go all the way up to 105, at which point anything above that you're going to be sacrificing. You're not going to be getting any more profit because you're selling a call here. So your stock is going to be called away at expiration. So you are limiting your profits here. So you have the $5 from 100 to 105. So that's $500 plus the premium that you got for the call, which would be $300. So 500 plus 300, max profit is 800. Max loss would be $9,700. Why? Because it's trading at $100. So you have 100 shares. So the total value is $10,000, but you're getting 300 as premium for the call that you sold. If the stock price collapses all the way to zero, then your call is going to be worthless, of course. So you keep the $300, but you lose all the way from 10,000, so from 100 to 0, which would be a loss of $10,000, which is going to be very slightly mitigated by the credit of $300. So 10,000 minus 300 would be $9,700. That'll be your max loss. The break even would be at $97, because if the stock starts going down at 98, for example, you lost $2, but you got originally $3 for the 105 call that you sold, and which is going to expire worthless if it continues that way. So the you have the credit that you got for the call as a sort of a cushion for your price to go down. So you have $3 of cushion on the downside. So 100 minus 3 is 97. That would be your break even. The approximate buying power reduction that you're going to get is going to be around $5,000. Why? Because usually in a margin account, you have a margin ratio of 2 to 1. So you might be only using $5,000, so half of the whole nominal value of the position. So now let's take a look at the put. The short 105 put, you're going to be getting a credit of $8 for it. So the max profit is going to be $800 because you can keep your whole credit, and the put could expire worthless if the underlying price at expiration is higher than the strike price that you sold, where you sold your put at. So you would have all this area as a potential profitable area, and you're going to be making your full credit that you got, which would be $8, and there are 100 shares in every contract, so 8 times 100, it's going to be $800 max profit. Max loss of $9,700 because you are putting your whole 105 put at risk. So that would be when the stock price goes to zero, you're gonna have to buy that stock at 105. So it's $10,500. But you got a credit of $8, so 800. So 10,500 minus 800 is going to be equal to $9,700. The break even is going to be 97 because you have 105 as your strike price, but you get $8 of credit. So 105 minus 8 is going to be 97. That's going to be your break even right here, because this is 105, but you got $8 on the downside. So the break even is going to be 97. The buying power reduction, if you have a margin account, and I'm talking about regular margin, I'm not talking about portfolio margin. Just regular margin is about 20% of the notional value of the position. So we'll be talking about 20% of $10,000 or $10,500. So an amount around $2,000. Okay. So as you can tell, this position is the same as this position. Same max profit, same max loss, same break even, different BPR, which would be one of the differences that we're going to analyze. So as observations, we have liquidity for out-of-the-money options is usually better than that for in-the-money options. This might make the short in-the-money put a more challenging position. So if we are trying to determine whether we're going to put on a short put instead of a cover call, we have to consider liquidity. If liquidity is similar, those positions are the same. But in some cases, once you go in the money, you start getting very poor liquidity for in the money options. So you have to consider that before deciding whether to put on a cover call or a short put. The BPR for the cover call will be equal to that of the long stock it's holding. So this is why in here, I'm not even considering the call. It's just how much do I need to keep in my account to carry the 100 shares that I have here. Okay. For the short put, the normal margining rules apply. So like I said, if we're not talking about portfolio margin, we're just talking about regular margin, we're going to have around 20% of the notional value of the position. So it's going to be around $2,000. But in some accounts, for example, in the US, you have an IRA account where margining is not permitted. You would need to have the cash for that put aside. It's called a cash secured short put. So if you use that, you're gonna need $10,000, or actually $10,000 and $10,500. But because you got 800 as credit, in reality you would only need to be putting up 9,700. So the max loss, you have to put up the max loss to carry that position if you have the requirement to be cash secured on your short put. And finally, in general, I would say it's easier to manage a position with less components. So if you have a position that has one leg instead of two legs, it's a little bit easier to maneuver, to adjust, to roll, etc. Another thing that's worth mentioning is the fact that dividends are going to be going into your account if you have a cover call. And if you have a short put, of course, you don't have any stock, so you're not going to be getting dividends. So for the cover call, you're going to be getting dividends. For the short put, you won't be getting dividends. The reason why I didn't even mention it is because option pricing already considers the fact that there's going to be a dividend cash stream going into the cover call and not into the short put. So the premium for the call is going to be affected and is going to be slightly less than that of the put if there is a known dividend that's coming up. Now, if there is a dividend that you didn't know about, then and those positions are already put on, then of course you're going to be affected and the cover call is going to be benefiting from that additional dividend. But in a normal situation, when there's a dividend that everybody knows about, the options are priced for them, and at that point you're going to be getting your money here in the form of a dividend, and here you're going to be getting your money in the form of a higher premium price for the short put when compared to the short call. Now let's go and take a look at a real example with real data on our trading platform. So now we're on a trading platform and we're going to be taking a look at Twitter. TWTR is the ticker symbol. It's currently trading at $30.09, $30.10. We're during market hours here, so the prices are going to be fluctuating a little bit. We're going to open up the June expiration with 31 days to go. And what we're going to do is we're going to be doing a cover call with a short call of 32. And then we're going to be selling that same put short, the same strike price, the $32 put. So first we're going to go and do the cover call. You can go here, come here and go buy cover stock at 32. So we're going to be long 100 shares of Twitter and one single short contract of the 32 call. So altogether, what's going to do is it's going to reduce the price of the stock that I'm buying by the amount of the call that I'm getting as premium. So if we analyze here, we can see this is the order. Buy one cover Twitter, 100 shares on the 19th of June 2020. And then we're selling the 32 call at $29.25. So the whole combination is going to be going to the trading floor at a price of $29.25. Okay, the break-even stock price is $29.25 because you have the premium that you're getting from the short call, which is around 85 cents as cushion on the downside. Your max profit is going to be the distance that you have from the current price all the way until your short call, which is 32, plus the premium that you got. So it's just around $2, so it'd be 200 plus the premium here. So a little bit less than 200, so around 190 plus 85, so around 275. This is the max profit. The max loss is going all the way to zero, so it would be $29.25, which is what you paid for the whole combination. Your short call is going to expire worthless if you do this analysis, and that's going to be your max loss. This is going to be the cost of the trade, and the buying power is going to be just about 50% of the notional value of the position. So just about 50% of $29.25 around $1,400. This is margining as if you were margining the stock, and that's it. So we're going to send it to analyze. Okay, and now we're going to do the other side. Instead of selling a cover call, let's delete this one. I'm going to be selling a put. I'm going to be selling the same strike put. I'm going to be selling the 32 put, one short contract of Twitter at 32 strike price for $2.81. So if we go confirm and send, you can see sell one contract of the Twitter covering 100 shares, 19th of June 2020, the 32 strike price, the put at a price of $2.81. The break even is $29.19 because you're getting $2.81 and your put is at 32. So 32 minus $2.81 is going to be $29.19. Max profit $281, which is the full credit if the price is at expiration higher than 32. The max loss is going to be all the way to zero. So because you're selling the 32 put, you're committed to paying 32, so $3,200 for 100 shares that could be assigned to you, minus the credit that you receive, which is $281. So it's going to be $2,919. The buying power effect, though, see how different it is. It used to be $1,400, which is what we got for the cover call. In this case, you have $600 because it's around 20% of the notional value of the whole position. Okay, so we're going to send this one to analyze, and we're going to take a look over there. So we have both positions here, and what we're going to do is we're going to be taking a look at the so first we have the cover call here, which is the 100 shares of the stock and a short call at 32, compared to a single short put at 32. Okay, I'm going to open up the pricing. So the pricing mechanism here is going to be taking the most current prices from the platform, so that we have, because remember we're in market hours, so the prices are changing. So first thing we're going to do is we're going to take a look at a cover call, and what we have here is a max profit of here around $288. Okay, so this is the max profit if the price ends up at expiration higher than 32, which is the strike price. Okay, so you're gonna have around $287. Okay, and on the downside, you're completely exposed all the way to zero. Now, if we look at the short put, we have $277 of max profit, so almost the same as the cover call, and we then have exposure all the way to zero, the same. So these two positions are equivalent. There is a small discrepancy which could be attributed to either liquidity or also to the fact that since you are using more capital here on the cover call, you need to put up $1,400 of capital. You need to be compensated for that. So in by way of an additional component for the interest rate that you're going to have to be either not making or not earning on that money that you are now committing to this position, as opposed to a put which uses only $600. So because of that, the income or the max profit here could be slightly less, but in general terms, they have just about the same profit, max profit, the same break even, and the same potential max loss. So these positions are equivalent. It's going to be up to you whether you want to do a cover call or a short put. Now, the short put, again, disadvantages is probably a little bit not so good liquidity, and the advantage is that you're only using $600. So it's a less of it's a smaller amount of buying power reduction. When you use a cover call, you're going to have better liquidity, but you're going to be using more of your capital, and it's going to be probably a little bit harder to manage because you have two positions now. Now you have 100 shares and also a short call, whereas for the put you only have the short put. Now, if Twitter paid a dividend, then you receive it in the case of the cover call because you are long the stock, and in the case of the short put you won't. But in this case, Twitter doesn't pay out dividends, so there is no difference there. So as you can see now, the cover call is the exact same position as a short put. And if you think about a short naked put, it's considered one of the most dangerous and one that traders are very scared of. But when you talk to them about putting on a cover call, they think that it's a very safe position, when in reality it's exactly the same position synthetically. So I hope that this information is useful for you and that you can apply this in your own trading. Thank you very much for your attention, and goodbye.